Welcome back to Talk Tickers. We're diving deep into the strategic core of the quarter's most compelling earnings calls. And today, our focus is squarely on Genworth Financial, that's GNW, following their Q3 2025 results. They reported on November 6th.
Yeah, this was a fascinating one, a real high-wire active and earnings call, you could say. You had this headline financial number that, well, it screened miss, but then the strategic announcements shouted growth. The company is basically navigating this major drag, this legacy business that's burning cash while, pouring money to a future growth engine.
Exactly. And that's the core puzzle we need to unpack for you. GNW reported adjusted operating EPS of just $0.04. That clearly missed the consensus, which was around 0.05 to 0.06 cents. Operationally pretty soft, yet the stock, it held its ground. It actually closed modestly positive after a pre-market pop. So investors looked right past the print. Our mission here is to figure out what story they bought into instead.
Okay, let's start with those headline numbers that caused the miss. Like you said, adjusted EPS was soft. But interestingly, their GAAP EPS looked much stronger at 0.28 cents. That's $116 million in net income, up a pretty solid 47% year over year.
And the top line. Revenue came in between $1.93 and $1.94 billion. So stable, maybe a modest increase of about 2.9% year over year. Nothing spectacular there. So yeah, clear operational miss on adjusted earnings, but the market didn't blink. Why? What did management say that just shifted the focus?
It shifted immediately. The conversation turned right to capital allocation and the transformation story. Investors, you see, they're not really valuing Genworth on quarterly adjusted earnings anymore. Those numbers are always going to be messy because of the legacy drag. They're valuing it based on the strategic flow of capital. And that flow really starts with the cash engine, their mortgage insurance subsidiary, Enact.
Enact, that's still the foundation, the bedrock of their financial strength, isn't it?
Absolutely. Enact delivered $134 million in adjusted operating income in Q3. Now, that was down a bit from prior quarters, but it's still very much the core earnings engine.
And the capital position there.
Extremely robust. Their PMI sufficiency ratio was 162%.
Okay, for listeners maybe not tracking insurance capital ratios daily, what does 162% actually mean in dollars?
It means Enact is sitting on roughly $1.9 billion above the capital requirements set by regulators. Billion with a B.
Wow. Okay, that level of excess capital, that gives Genworth enormous flexibility.
And that flexibility feeds directly into what they call strategic priority one, extracting shareholder value through capital return. This is where the story gets really compelling.
Okay, so how much came back in Q3?
Genworth got $110 million in capital returns from Enact just in Q3 alone.
And since the IPO, since Enact went public in 2021.
That total dividend stream flowing back to the holding company is now over $1.2 billion. It's substantial.
Okay, but what about looking forward? Did they update guidance?
They did, and this is really eye-opening. Huh? Enact now expects to return about $500 million in total for 2025. And get this, a massive $405 million of that flows directly to Genworth, the parent company.
$405 million. That's serious cash flow, kind of non-negotiable proof the Enact engine is working as planned.
Exactly. And that cash isn't just sitting there. It's being recycled immediately into shareholder value.
Meaning buybacks.
Meaning buybacks. GNW repurchased $76 million worth of stock just in Q3.
There was more news on that front too, right?
Yes. The board approved a brand new $350 million share repurchase authorization. A big commitment.
So what does that do to the full year guidance for buybacks?
It pushed their full year 2025 buyback guidance up quite a bit. Now they're targeting an aggressive range of $200 million to $225 million.
Okay, $200 to $225 million. Do they have the cash at the holding company level to actually do that?
They do. They finished the quarter with $254 million in cash and liquid assets at the holding company. So yes, they have the dry powder ready to execute that plan aggressively.
Wait, let me just push back on that for a second, though. If Enact, the core engine, made $134 million operationally, but the legacy long-term care block lost $100 million. I mean, doesn't that basically wipe out the operating income right there? The net number is razor thin. Why are investors so comfortable with them funding a, $200 million plus buyback when the core operating engine seems barely profitable on that adjusted basis?
That's a really crucial question. And the answer is kind of twofold. First, Enact's cash flow is seen as recurring, stable, predictable almost. And that LTC loss, while large, is primarily a non-cash statutory accounting loss. Management is working hard to isolate that loss to wall it off.
Okay, so isolate the bad, and the second part.
The second part is that the market is buying into the future. They're focused on strategic priority 3, building CareScout. Building CareScout into a legitimate growth platform for aging services, that's the upside story.
Right, CareScout. This is the pivot narrative, isn't it? Trying to shift from just being an old school LTC insurer to becoming a tech-enabled service platform for aging. How's that actually scaling up?
Well, the network scale is actually pretty impressive now. The CareScout Quality Network, the CQN, includes over 700 providers. Those providers cover more than 950 locations across the U.S.
Okay, numbers sound good, but what's the reach?
The key metric here, the one for you to focus on, is that this network now provides home care coverage for over 95% of the U.S. population aged 65 and older.
95% coverage. Okay, that's basically national infrastructure they've built.
Pretty much. And it's not just sitting there, they're using it.
Are they actually connecting people with care? What are the match numbers?
Yeah, they're showing real traction. Year-to-date matches connecting policyholders or just consumers with care providers hit 2,330 through October.
And the outlook for the full year?
Management sounded confident they'll finish 2025 with over 3,000 matches. That actually beats their original goal.
Okay, exceeding goals is good. Any strategic moves to expand that reach further?
Yes, they specifically highlighted the acquisition of Seniorly back in October. That move is designed to accelerate their direct-to-consumer channel and, importantly, extend the network into senior living communities. So moving beyond just home care.
Broadens the addressable market quite a bit.
Dramatically.
But I still have to ask, is the market really comfortable with them investing, nearly $50 million into a division that's still basically a startup, especially while the core legacy business is actively losing money? Management said they expect to spend $45 to $50 million on CareScout this year, CapEx and OpEx combined.
Right. And they justify it by linking CareScout back to the LTC business itself. It's kind of clever. They're using the platform to innovate on products that actually reduce their own risk exposure going forward.
How so?
CareScout launched its first standalone LTC product called Care Assurance just in October.
Yeah.
And the pitch here is that this new product is specifically designed to reduce risk and, crucially, minimize the need for those huge future premium increases that plagued their legacy products.
So learning from past mistakes. Using the new platform to design better, less risky products for the new book of business.
Exactly. That's the idea. They also mentioned plans for market-linked and hybrid LTC designs. So they're signaling they want to aggressively re-enter the growth market, but on modern de-risked terms.
Okay, that makes sense strategically.
But now we have to address the elephant in the room, the unavoidable headwind, the drag that actually caused that dollars of force operational miss in the first place, the long-term care segment. This is the weight that keeps the stock's multiple kind of capped.
Yeah, that segment posted a $100 million adjusted operating loss in Q3. And what worries me is that loss was actually worse than the Q2 loss.
It was, driven by unfavorable experience specifically, fewer people letting their policies lapse, lower terminations, and higher benefit utilization.
So basically, people are living longer, holding onto these policies, and needing care sooner or more intensely than the original math predicted.
Precisely. And the pressure is real. The U.S. life companies, on a statutory accounting basis, posted a $12 million loss for the quarter, largely reflecting that pressure from LTC claims.
Which is why the mitigation strategy is just paramount.
Absolutely essential.
Okay, let's clarify that mitigation strategy for everyone listening. It's called the Multi-Year Rate Action Plan, or MYREP. Sounds technical, but what's the core mission? What are they trying to achieve?
MYRA is basically the long, difficult process of going state by state, regulator by regulator, to get approval for raising premiums and sometimes reducing benefits on those old existing legacy policies.
Sounds like a tough slog. Politically difficult, too, I imagine.
Hugely challenging. It's an enormous effort. But they've made progress. Since 2012, they've accumulated $31.8 billion in net present value from approved rate actions.
$31.8 billion. That's a staggering number. It really reflects the scale of the problem they inherited.
It does. And they've also achieved a cumulative benefit reduction rate of 60.5% on affected policies.
So what's the end game here? What does management keep reiterating as the critical long-term objective for this effectively closed legacy block?
The objective is deceptively simple. Get the LTC block to roughly break even on a statutory basis.
Break even, not growth, not profit, just stop the bleeding.
Exactly. The legacy business just needs to generate enough cash flow internally to cover its own liabilities. The key commitment is ensuring the holding company will not be required to contribute capital to the legacy block, nor will it receive dividends from it. It has to be self-sustaining.
So successfully executing MYRAP is the difference between that self-sustaining runoff and, well, a bottomless pit draining cash forever.
That's the critical execution point. And that commitment, that firewall between the holding company and the legacy block, that's what allows investors to look past the LTC losses to some extent.
It lets them focus on the Enact cash flows and the CareScout investment separately.
Right. Oh, and one final piece of potential, let's call it potential good news on the legacy side, though it's definitely not banked yet. They mentioned the pending excess and tander litigation appeal. There was a favorable ruling for Genworth in the UK High Court.
Right, I remember that. What's the potential recovery amount?
If that ruling is upheld on appeal, they could recover around $750 million.
$750 million. That's massive. Compare that to their current buyback guidance for the whole year, which is $200 to $225 million. $750 million is more than 3 times their entire current annual capital return plan. That's huge potential upside.
And management was very clear. This potential recovery is not factored into their current buyback guidance or capital plans. So it would be a powerful incremental boost if it actually comes through.
Okay. So pulling it all together, the entire market narrative seems to have shifted, hasn't it?
Completely. Investors are now viewing G&W less like a struggling LTC insurer and more like, well, like a robust capital return vehicle. A vehicle fully backed by those predictable Enact cash flows, but with a significant call option attached. That option being CareScout's future growth.
And that shift in perception, that's why the stock's performing so well relative to peers, right?
I think so. GNW's one-year total return is running around positive 16%. Compare that to the broader KO insurance ETF, which is only up about 1%.
That difference really tells you the market is rewarding management's strategic transformation, or at least buying into the story.
Definitely rewarding the story, and it's a big bit. But the forward-looking risk remains that LTC volatility, that under $1 million quarterly loss is a constant reminder that execution risk on MYRA is very real. If those statutory numbers deteriorate unexpectedly,
then that volatility could keep the valuation multiple capped no matter how well CareScout does.
That's the fear. That's the overhang that keeps some investors cautious despite the CareScout growth catalysts.
It raises an important question that actually came up in the Q&A on the call. If the long-term goal is separation, how long is this legacy runoff expected to last?
Yeah, the CEO addressed that directly. He confirmed the legacy LTC business is a long, long tail. Think 30-plus years for the runoff.
30 years. Wow.
But critically, he also reiterated that the new CareScout business is set up completely separately, structurally distinct, and it could eventually stand alone from the legacy company. That potential separation, achieving a true sum of the parts valuation, that's really the ultimate upside catalyst investors are eyeing long-term.
Okay. So if the story is indeed proving stronger than the earnings print and the market is already rewarding this transformation, let's talk valuation. What's the market truly pricing in, and where might the gap be?
All right, well, this is the point where we firmly remind you that we're analysts sharing our observations, our notes from the call. We are absolutely not your financial advisor.
Definitely not. We encourage critical thinking, but please don't take any of this as investment advice. This is not financial advice segment. Okay, disclaimer delivered. Given this fundamental arbitrage opportunity we've been discussing, this cash-rich engine funding buybacks layered over a legacy runoff and a growth startup, we do have an outrageous but plausible trade idea. It focuses squarely on that implied valuation gap, the sum of the parts angle.
The trade idea is pretty straightforward. Long G&W, you're essentially betting on that some of the parts value unlocking over time. The core thesis is that the market, even now, is still assigning too much of a discount to the entire entity because of the troubled LTC legacy. A legacy which, remember, management explicitly tells investors to consider isolated and hopefully self-sustaining.
So the idea is today you're buying the intrinsic value of the cash cow, Enact. And Enact is funding huge, immediate, sustainable buybacks that support the price right now. And alongside that, you're essentially getting the rapidly scaling aging services platform, CareScout, for, well, maybe almost free in the current valuation.
The rationale is pretty compelling, right? Buy today, you benefit immediately from a company executing, let's say, $200 million plus in buybacks this year alone. That provides a nice cushion. Simultaneously, you hold what amounts to a long-term call option on significant multiple expansion. That option pays off if CareScout successfully hits its targets, thousands of annual matches, new products taking hold, and eventually executes some kind of spin-off or standalone transaction. separating itself from that long 30-year legacy runoff.
Right. That separation event, creating a pure play, potentially high growth, tech-enabled aging care company, that's the kind of catalyst that can fundamentally re-rate a stock. It could unlock significant shareholder value well beyond what the current multiples, arguably still capped by the LTC drag, reflect today.
So wrapping this up, what does it all mean for you, the listener? Q3 was really a classic missed the print by the story quarter, no doubt about it. The focus was entirely on management successfully, or attempting to successfully isolate that legacy risk, and their clear commitment to the strategic pivot towards CareScout and capital returns.
Yeah, the Genworth story today is really anchored by that dual engine, isn't it? You've got the robust Enact cash flows funding those aggressive buybacks right now, while that $45 to $50 million annual investment is aimed at building CareScout into a legitimate long-term growth story targeting that huge underserved aging care market.
And as you track this story going forward, here's a final provocative thought to mull over. Management keeps hammering home that the legacy LTC block's goal is just break even on a statutory basis. Nothing more. So think about this. How much additional capital freedom would successful over-execution of the MYRP actually unlock? If they can stabilize that legacy block even better or faster than break-even implies, well, that success translates directly into more future capital available for even bigger buybacks or faster investment in CareScout. In a weird way, managing that old legacy block successfully might actually be the key that determines the ceiling for future cash deployment.
Interesting angle. How well they manage the past dictates the resources for the future. Great analysis. Thanks for joining us for this deep dive into the strategic transformation playing out at GNW. We'll catch you next time on Talk Tickers.